Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hi, everyone. Welcome to the Note Investor Podcast. I'm your host, Dan Deppen. And in this episode, I'm going to take a little different tack, and I'm going to be talking about note investing for newbies. This is intended for people who are kind of brand new to the note space and are trying to wrap their head around it and figure out what's going on, how they can get involved, and what some of the opportunities might be in this really cool space. So if you've been following me for a while, you'll know most of my content that I put out tends to be a little more advanced and kind of down in the weeds, but I've been getting a lot of requests for more beginner type material. So in this podcast, I'm going to really just focus on some of the basics that you'll need to know. So we're going to kind of start by just talking about what the heck is note investing actually. And what note investing is when you're buying a note or a loan instead of the actual property. So once you own this note, you can then begin either just collecting payments, or if the borrower is not making payments, you can potentially foreclose, and you're basically just acting like a bank. That's why some people refer to note investing as being a landlord instead of a landlord. You're basically acting like a bank. The difference is typically, a note investor is buying a note that already exists and not necessarily creating a new one, although a lot of times people do create new ones using seller finance. I do that somewhat myself, but you want to think of yourself as being like a bank instead of a landlord. As you can probably guess, being a banker is kind of generally a pretty good position to be in. So let's talk about what a note is itself. So a note is really just a promise to pay that some borrower made, or referred to as a promissory note. I first came across this when I was a kid, probably 6, 7 years old, playing that board game Life, where they had those red $20,000 promissory notes. I remember when I was little wondering, what the heck is that? And my dad actually worked in the loan business at the time and explained to me how that works. Now, you're not going to have just a note by itself, but there's going to be a note and then some kind of security interest attached to a piece of property. So generally that's a mortgage, although it's generally referred to in the industry as just a note. In reality, you're typically getting a note and a mortgage. There's also another variation on that called a contract for deed that I run into a lot. I'm really not going to deep dive on this one. Those work in sort of a similar way, but there are some key differences there too. That's probably a good topic for another podcast. But when we say note, we're kind of talking about two things: some promissory note and then some kind of security instrument attached to the property. And what that security instrument is basically doing is saying, okay, if the borrower does not perform on the note, do not make payments, or do not live up to what they agreed to, then the lender can make a claim on that piece of property or that piece of collateral that's using to secure the loan. So there are basically two different types of notes you can buy as an investor. The first bucket is performing notes. And so when you buy a performing note, you're just buying a payment stream. So you buy this note, and then you receive payments every month. Most of you listening to this probably have a mortgage, and you probably pay it every month. And you might be thinking, like, well, what other kinds are there? Like, why wouldn't you pay your mortgage every month? But that certainly doesn't always happen. And that brings us to the second bucket, which are the non-performing notes. So non-performing is kind of a broad category. But again, I'm keeping it simple for this episode. And non-performing basically means that the borrower is either not paying, or they might be making some payments, but they're behind on the loan. So if you buy a non-performing loan, you're not just sitting back and receiving payments every month. The note's going to have to be considered worked out in some way to get to a resolution. And later on in this, I'm going to talk about some of the things you can do to work out a non-performing note. And you might be wondering, like, well, why in the heck would you ever buy a non-performing note? Why would I buy a loan with borrowers not making any payments? And there are a lot of good reasons why you might want to do that. For one, they're obviously sold at a much larger discount than a performing note. And then there are all sorts of things we can do with non-performing notes, either working with the borrower to get them re-performing, and now we can resell it at a smaller discount, or foreclosing or doing a few other things potentially to get the property back, and you can use it as a property acquisition strategy. And the reality is there are a million shades of gray in between. For the sake of this, I'm putting it into 2 buckets. In reality, there are all different types of non-performing loans, either ones where they're just a little bit behind all the way to, I've seen loans where the borrower hasn't made a payment in like 10 years and the property's abandoned. And in my system, I put those in different categories, but for the sake of this, I'm just going to try to keep it straightforward. All right. So now we've talked about kind of like what note investing is, what notes are, the types of notes. But now I'm going to talk about why I buy notes and why you might be interested in doing the same. And there are a lot of good reasons why you might. Number one is cash flow, right? Investors are always looking for, investment options to just generate cash. And notes are a really great way to do that because they don't necessarily carry some of the obligations that buying a rental property would have. And the returns are generally going to be a lot better than, let's say, a dividend paying stock or some kind of treasury bond or corporate bond or things like that. You can get really, really good cash flows with these. Often when I'm buying performing notes, generally 8 to 15% annualized return based on the riskiness and some other characteristics of the loan. And the second reason is those higher returns, right? So if I'm buying a performing note and I'm getting 8 to 15%, that's usually a lot better than my other fixed income options. And then if I'm doing non-performing notes, I have the opportunity to potentially make even more, although that carries risk with it, right? One of the things I always emphasize is there's no free lunch, and you want to be careful about just grabbing a deal that looks like it has a potentially higher return, because there's generally higher risk that goes with it. That doesn't mean that's a bad thing. It just means you want to be really thoughtful about how you do these things. But generally speaking, you can get much higher returns than in other investment classes. And the reason for that is reason number 3 for buying notes, which is there tends to be a lot less competition. So if you're looking at buying, let's say your model is you want to buy REOs to either do fix and flips or, turn them into rentals or turn them into turnkey rentals, there's generally a lot of competition. There are a lot of people in that game. Or if you're trying to wholesale, there are thousands and thousands and thousands of people who do that. Note investing has a much smaller pool of investors. So even it's a nichier industry than some of the other forms of real estate investing. And what I like about it is I can generally get better returns, and I'm not competing with hordes and hordes of people to do it. So that's part of the reason why you can get these higher returns, right? There's a reason for everything, right? It's not just this magical thing where the higher returns are sitting around. There are reasons for that, and a lot of it is just not as many people know how to do this. And the good news is it's not necessarily as hard to do as some people make it out to, and you don't have to spend $75,000 with some guru to learn how to do it. So I like it a lot. Reason number 4 is that you can avoid some of the issues related to rentals, right? So when you're a bank, you're just collecting payments and dealing with the loan. You have an interest in the property, you can foreclose it, but you don't actually own the property, right? So if your toilet clogs, you don't call Bank of America, who may have your mortgage, right? You don't have to deal with that. Now, there is a flip side to this as well that I'm going to get to here shortly. If you foreclose and end up with an REO, now you've got something that could be more challenging than a rental. But in general, these are a lot more hands-off. You're not hiring a property manager. It can be simplified, particularly if you're buying just performing notes for cash flow. Now, reason number 5 can be a lower cost method of acquiring property. Now, some of these depend on what your strategy is. So if you're just buying performing notes for cash flow, you're not trying to acquire the property, right? That means the loan stopped paying. That's not good. But what some people do, if they do want to do fix and flips or create rentals, and especially now with COVID and some of the courts slowed down, the supply of real estate inventory is really, really low. I was just talking to a friend of mine here in the Denver area that's a Keller Williams realtor, and he was telling me that in the Denver metro area, there are total housing supply is like 3,500 houses for sale. And to have what they call a stable market, they need 35,000. So properties on the market. So right now, at least in Denver in late 2020 when I'm recording this, the supply of inventory is 10% of what you need for a stable property. So if your investing model counts on you getting properties, it's really difficult right now. However, if you buy a distressed note and then either foreclose or work out a deed in lieu with the borrower, that can be a way to get properties that are off market. And then generally your total acquisition cost is going to be quite a bit lower than if you go out and you're bidding against everybody and their uncle on a property. Oops. And then reason number 6 is it's a great way to grow your IRA. So in my IRA, I own a bunch of performing notes that yield that have pretty high yields on them, and I just let those sit there and grow. So right now, with the stock market being very high and a lot of volatility and potential volatility as we get into the next couple years and these after effects of the pandemic shake out, I think there's a lot more impacts to come. The stock market is kind of dicey. Yields on bonds are very low. So I think this is a really good way to get a high yield in your IRA, but then also have collateral behind it, right? The other advantage right now is property values have really gone up. So a lot of these loans you can get good yields on have good equity. So if for some reason the borrowers do stop performing, you got a lot of equity there to make yourself whole and even potentially profit more in some cases. So it's a great way to grow your IRA account. But there are also some disadvantages to notes. One of my pet peeves in this industry is when a lot of people talk about it, they talk about all the good things and they don't talk about any of the potential negatives. They take what I call like the rainbows and unicorns approach, that just everything is rosy and everything is great. And while I think it's a much better space than others, that's why I play here, there are some things just to be aware of. So number 1 is, loss of some of the tax advantages. So one of the great things about investing in real estate is some of the amazing tax advantages that you can take advantage of, right? Like everyone was talking recently about Donald Trump's like $750 tax bill. And the people who get upset about that don't understand all of the amazing advantages that the IRS gives you if you're investing in real estate. Well, if you invest in notes, you don't get a lot of those advantages. So you're not able to claim depreciation and some other things. So, and that's another partial reason for some of those higher returns. Net, you still do better overall, but it's just something that you should be aware of. And then the second one is, I mentioned how notes can be a lot better than rentals because you don't have as much to deal with. However, if you do have one that stops performing and you need to foreclose and you take it back, oftentimes those properties are in rough shape. And so you can actually end up with more headaches than a rental in some situations. It doesn't really happen often to me. But when it does, it's a pain. I had one a while back that was a hoarder house with just tons of trash. So that was, a lot more work to deal with than a tenant calling me up about a clogged toilet or something like that. So it doesn't happen often, but it can. So it's just something to be aware of. And then the third thing is I mentioned how there's less competition in notes. The flip side of that is when you go to sell your notes, there are fewer buyers out there, right? So it's a little less liquid of a market overall. You can still sell notes pretty easily, and I'll talk about some ways to buy notes coming up, and you can sell them using those same resources. And I sell notes all the time, but just that process is a little different, and it can sometimes take a little bit longer than a traditional real estate transaction. So the big question that I always get is, where can I go to buy notes? And there are a lot of different places you can go. I'll hit some of the main ones here, but actually, if you want a little more complete list, if you go to diffusionnotes.com website, and if you haven't been there before and you scroll down a little bit, you should get a pop-up where you can download a free guide with 8 places to buy mortgage notes. But some of the main ones are, as far as online platforms, there are a couple different online platforms. The main one that I use is paperstack.com. I like them a lot. And actually, that's generally when I sell notes. That's where I tend to go for the most part. There are also some reputable brokers out there. So if you go to directsourcere.com, a gentleman named John Keith, if you get on his list, he sends stuff out on a regular basis. And then SN Servicing, which is a servicing company, they have a brokerage desk at all that as well that sends out notes on a regular basis. So David Polio is the guy that runs that. And then the other place that I've been buying a lot recently is just from other note investors. So one of the best things you can do is build a network, join some of the Facebook groups that are out there, and build a network, because what happens is people who are investing in notes often invest in other real estate deals, whether they're doing rentals or self-storage or multifamily or whatever. And oftentimes they're looking to liquidate some of their notes because they have some other hot multifamily investment or whatever it is they want to go do. So if you have a good network and a good reputation as a solid buyer who's going to follow through, I oftentimes buy notes where people just contact me and say, hey, Dan, I want to get rid of this. Are you interested in it? Because they know if it fits my investment model and the price is reasonable and there are no issues with the note, that I'm going to be able to close on it pretty quickly. So that's one of the best ways to do it. So those are some quick ideas to get going on buying notes. Like I said, if you go to the Fusion Notes website, you can download that guide for free, and it'll give you some more resources beyond this, and then also some links that you can click on and things like that. All right, now when you start buying notes and running them, there are a lot of different vendors that you're going to need to rely on. In fact, one of the nice things about note investing is you can set up a team of vendors and let them do most of the work, and then it's a matter of just following up with the vendors and making sure everything's happening the way that it's supposed to. And I'll talk about 6 different types of vendors that you'll need. And number one is realtors. So my realtors do a lot for me, and generally I'm investing all across the country. I'm based in Colorado. I don't actually buy any notes here because they're not really available, because our market's just been too smoking hot, to have any. But the realtors are going to do a lot of different things for you, and you're going to want to have a good one in each of the markets that you're operating in. So when you're in the stage of buying a note and doing your due diligence, they're going to be able to do drive-bys and give you photos, give you estimates of the value. If you do start taking properties back, they can sell your REOs for you. And then also when you get REOs, they can help coordinate with property managers, hook you up with local vendors if you need to do any rehab work or anything like that. And then I've even had some amazing realtors who have gone to court for me. Like sometimes, depending on the jurisdiction, if you're doing a foreclosure, you have to have a representative in court. Sometimes your attorneys can do that for you. But I've even had some amazing realtors who have gone in and done that for me as well. So finding the right ones are like gold. The other thing too that I'll point out when you're looking for realtors in a particular area, you want ones who specialize in distressed assets and foreclosures. Most of the realtors aren't going to be familiar with note investing or understand it, but if you call around and start asking for ones who do short sales and foreclosures and REOs, you can usually find the right one in your area. And then when you find the good ones, remember them and treat them well. So the second type of vendor are title companies. And so generally I'm using this to pull title or O&E reports as part of my due diligence process. So an O&E report is just kind of, it's an ownership and encumbrance report. I think of it as kind of like a mini title report. And then also, obviously, if you get REOs and you're selling them, then they're going to help you with that closing process. So number 3 are your attorneys, and this is something you're going to leverage really heavily. One of the most important areas to utilize an attorney is doing a review of the loan documents before you actually close. So every state has their own nuances. So you're going to want an attorney who's a foreclosure attorney and licensed in that state to review your docs before you close, because sometimes you can find little issues on mortgages or in the title work that they're going to be able to spot. For me, I am, full disclosure, not an attorney. I've reviewed enough loan files that I would say I know enough to be dangerous, and I'm at the point now where I can probably spot most issues when I review the docs. However, sometimes different states have different little nuances, and I'm not an attorney myself, so I always get that doc review done up front as basically an insurance policy to make sure I don't make a big mistake and buy something that's not enforceable or I can't get clear title. And then obviously you're going to use attorneys if you start doing foreclosures, or if you do a deed in lieu with a borrower. So that's when the borrower just basically agrees to leave and sign the property over. So you obviously need legal documents to do that. And then also if you are taking outside money, or if you're providing money to an operator for a deal, obviously you're going to have either, it could be a joint venture agreement or some kind of partial agreement or something else. You're going to want attorneys to review those as well to make sure that they're solid and everything is correct. Number 4 are your insurance companies, and you use this for forced place insurance. So oftentimes if you have a non-performing loan, if the borrower is not paying the loan, they're typically not paying the insurance either, and often the taxes as well. So as the lender, you have to protect your interests. So if the borrower is not paying for insurance or providing proof of insurance, then you need to get your own on that property, which is called forced place insurance, or FPI is how people generally refer to it. And this is super important because I've heard a lot of stories of houses falling on trees and houses burned down more than you would think. I actually just had one burned down this year and insurance paid off in full. So one of the very important things is you want to make sure that either your borrowers have insurance or you're putting insurance in place yourself. And then number 5 are your loan servicers. And by the way, these are in no particular order. The loan servicers are the ones that you're probably going to interact with the most on a regular basis. And you highly recommend that you always use a loan servicer. Some lenders note investors try to save money by self-servicing notes. And that is a really horrific idea because there are a lot of regulations that need to be complied with. And as an amateur doing it yourself, there's no way you're going to comply with all of them. And even if you manage to, it's going to be so much work. It's not going to really save you any money at the end unless you're valuing your time at 10 cents an hour or something like that. But what the loan servicer is going to do for you, they're going to do a lot for you. So they're going to send statements out to the borrower. They're going to collect the payments from the borrower and then make the deposits to you. They're going to manage the escrow account. So I always like borrowers to have taxes and insurance escrowed. So your servicer will track that, collect those escrow payments, make tax payments out to the county. That's really great. And then they'll also track the unpaid balance of the loan as payments come in. If the borrower is behind, they'll keep track of late fees, past due interest, other accruals. They can also do loss mitigation for you. Loss mitigation is when a borrower is missing payments or is delinquent, and they'll do outreach to the borrower to see what's going on, potentially work out some kind of a deal. And then sometimes, depending on the type of servicer, they may coordinate the legal process as well. So some servicers are kind of what I call full service servicers. They just do everything, or they are supposed to do everything. They don't always. And then other servicers do a certain portion of it. and then I'll manage other things like coordination with the attorneys. I like to do it that way because then I know things get done well. One of the big things with loan servicers is you have to follow up on them because they have a lot of loans. A lot of times the asset managers who are working these are not well paid. And so in theory, these things should be, loan servicers should be like Nirvana. You just hand it off, you pay them so much every month and they do everything. The reality is not quite like that. I could have included this in one of my disadvantages of buying notes section earlier. You do have to make sure you're following up with them. But if you follow up with them on a regular basis, establish a good relationship, they really can become your best friends. And then number 6 are property managers. So now if you're just buying performing loans and collecting cash flow, you're not going to need a whole lot of property managers. But if you start doing non-performing and taking properties through foreclosures, you're going to have REOs, and you're going to need someone on the ground to help you with doing inspections, winterizing the property, especially if they're towards the north, which a lot of these are, securing the property. So when you take an REO back, right, you're going to need to change the locks, get everything secured, potentially winterize it if it's in, depending on the time of year and the geographic location. If you do decide to take on rehab work, a lot of times your property manager will have vendors that can help coordinate that as well. All right, so now we talked about the vendors that you need. The other question people have is, what's the actual process for buying a note? Like, how do you actually do the transaction? And how is that different from a traditional real estate transaction? And these are generally quite a bit different. So I'll kind of just walk through some of the steps. So once you've made contact with some of these sellers, right, on a periodic basis, they'll send you what's called a tape of notes. A tape is just a spreadsheet with a list of notes that are for sale, but you'll hear that term tape mentioned a lot in the business. So once the seller sends you a list of notes for sale, you'll review it, you'll do your initial due diligence, and if there are ones that fit your model and your criteria, then you may submit offers to the borrower. That offer is generally considered an indicative bid. You're not really committed at this point. So you make your indicative offers. The seller is either going to accept, reject, or make a counter. But if you get to a point where offers are accepted, then you'll begin your post-bid due diligence. And this is the part where you're going to dive deeper and make sure that the title's clear, try to do some assessments of the value of the property, and know that you're good to go to close. At that point, you're ready to close the deal, you fund it, and then they transfer the loan to you. But now I'm going to walk through a few more of the details on this. I know this is the note investing for newbies, but I think some of these nuances of the transaction are just kind of important to understand up front because they are a little bit different than some of the other things you may have done in the past. So I mentioned in that flow there were kind of 2 phases of due diligence, right? So we did a certain scrub before we placed our offers or our indicative bids. And then we did our deep dive after our offers were accepted. The reason for this is most offers don't get accepted. I think I was keeping stats on this for myself for a while. I've kind of stopped doing that, but for a while I was running at about 10 to 15% of my offers getting accepted. So because of that, and some of the deep dive due diligence costs money, right? So a lot of times you're paying for BPOs, you're paying for O&E and title work. That costs money. So you don't want to spend a couple $100 if you only have a 10 or 15% chance of getting the deal. So we do our initial scrub before we put in our offers, and we're doing things like filtering the notes to make sure that they fit our investing strategy, right? If we're looking for cash flowing notes, we're not going to want to put in offers on non-performing. Or if we have certain states that we're focused on, we're not going to want to bid, assets in states that don't fit that. And then you're going to look at your return, do your return analysis and your pricing. At that point, you make your offer. Now, once an offer is accepted, we're diving deep. We're going to review the complete pay history and the servicing notes from the previous lender to make sure that's all in line with what our expectations were. We're going to verify the property value as best we can, usually either pulling a BPO or having a realtor go by, maybe pulling some comps. one of the big challenges, or one of the just things that's different with note investing, right? When you're verifying your property value, there's a borrower inside the property, so you can't get inside. So when you're assessing your property value, you have to assess the outside and then make your best guess of what's going on in the inside. And so that's one of the risk factors in notes that you may not have in other forms of real estate investing. And so with that risk, and that's part of the reason too why you can get a higher return in note investing as well. So you're going to run your title work, which is usually that ownership and encumbrance report. And we're going to do things like check if there are past due taxes, verify the chain of title is clear, see if there are other liens on the property as well. So there could be like code violation liens, other sorts of things. And then the other thing I like to do is make some phone calls. So if the property is supposed to be owner occupied, then I'm going to do things like call to verify the utilities are on, right? So if the seller says the loan is owner occupied, then I call and the water and the electric is shut off. There's probably no one there. I also like to call code enforcement to see if there are any violations. Sometimes you learn amazing things. Like I've had loans that I was interested in buying where I talked to the code enforcement guy and I find out that this property is like their problem child property in the neighborhood, and there are all kinds of issues with the borrower. Other times, things are clear. And then we end with our attorney review. So after we go through all of this, I send the title work and the loan documentation. These are soft copies of the loan documentation to the attorney to review to verify that everything's good and there's not something that I missed or some nuance in this state that may cause a problem that I was unaware of. And the big thing I'll emphasize to new folks, because I have heard horror stories of people doing this, is you must never ever contact the borrower, right? So with loans, borrowers have a lot of rights and there are a lot of regulations to comply with. And I'm not an attorney. I'm not going to try to like deep dive on all of those and explain what they are. But one of the big ones is you're not contacting the borrower, especially when you don't own that loan. And even after you buy the loan, I don't recommend contacting the borrower directly. I would recommend letting your loan servicer handle that. So yeah, I've heard stories of knuckleheads looking to buy a loan, and then I've even heard a story of somebody knocking on the door of the borrower. I guess they're trying to figure out if they're going to start paying again or not, but you can't do that. Not at all. You can get in big trouble for doing that sort of thing. All right, so actually closing a note deal. So this is the other area, right, that's a little bit different, and I'm going to show kind of two different workflows. The traditional closing in the note industry is kind of the Wild West, and it's very important that you know your seller and you kind of know who they are. So typically note transactions don't go through escrow or a title company like a traditional real estate transaction. Basically, usually what happens is you've made your offer, you've agreed to some price, you've done your deep dive due diligence, you're ready to proceed. And at this point, there will be a loan sale agreement that both parties will sign. And then the buyer wires the funds directly to the seller. And then the seller will do two things. They'll tell their loan servicer to transfer the loan to you, and then they'll ship you the hard collateral file. And this is done all the time, and it works okay. A lot of people are kind of freaked out by this because you're wiring funds to somebody, and what happens if they don't transfer the loan, right? Or they don't ship you the collateral. That's obviously a risk. So it is sort of the Wild West. I do this all the time, but I know my sellers and they're people that I've worked with and trusted. However, what I consider kind of the newer model is what paperstack.com is doing. So they're an online platform for selling loans, and I mentioned this in the section where you can find places to buy. It's definitely a place I like going to, and I think their method is the way of the future. So this is a little more traditional, right? So in the PaperStack system, they have a really detailed checklist that they go through, and I'm not going to talk about the whole thing here. But basically, instead of wiring funds directly to the seller, you're wiring funds to escrow. They have an auditor that they use, and so the seller then ships. So the buyer wires the funds to escrow. The seller ships the hard file to their auditor. The auditor verifies that everything's included in the file. The file is clean. And so at that point, they initiate the loan transfer. They wire the funds to the seller, and then they ship the hard collateral to the buyer. So this is a lot more protected. This saves you from if you run into some kind of bad actor who doesn't ship you the collateral or doesn't ship you all the collateral, you run into some kind of a problem that way. I think this is really the wave of the future. It costs an extra couple $100 to do this. I think it's well worth it. I think it's just kind of the right way to do things, but I use the traditional method all the time with people that I know, and it's not uncommon to do that. Although it's also not unreasonable. Let's say you're just doing this between two people and maybe you don't know them as well, to ask to set up escrow. It's not done a lot, and a lot of people will push back, but I think that's a very, very reasonable ask. All right, so now we found our notes, we've come to agreements, we've bought them, had the loan transferred. What happens actually after we close? And there's a lot going on here that I want to explain, because this stuff, everything in the loan transfer and the setup tends to take longer than everybody expects. It's not like when I first started buying loans, I came to this from a stock investing background. I was used to, like, if I want to do a stock trade or buy an option, I do the trade, I click a button, and it's on like a minute later. Just transferring a loan after the close can take 1 to 2 months. I mean, usually it's a couple weeks, but I've had them take longer. Some of these servicers can be very pokey in how they do things, and you definitely often need to follow up with them during the transfer process. So, but yeah, it can take fully 1 to 2 months to transfer a loan. Now, once the loan servicers initiate the transfer, the new loan servicer, if you've changed it or even if you haven't changed the servicer, but once the loan changes hands, there will be some what's called RESPA requirements that need to be met. So the new servicer will send out what's called the hello letter to the borrower, and then the previous servicer will send out what's called the goodbye letter. So this is notifying the borrower that their loan was sold. And you may have had this before. I know that the mortgages I've had on my primary residence, have been bought and sold several times over the last 20 years or so. So you may have seen this before, but that's notifying the borrower, and that's needed to comply with RESPA requirements and other things. Now, once you get the loan boarded with the new servicer, your servicer will give you access to a portal. So they'll have some kind of online platform that you can log into, and you can see what's going on with your loan. All the data on the loan, the payments that have come in, the notes, and other things. And then once they do that, you want to go back in and you want to verify that everything's in order, right? So sometimes, because these loan transfers take a while, right, payments will often come in between that transferring time. Now, in your loan sale agreement, there should be what's called a cutoff date specified. And that means that after such and such a date, all the new payments come in, get forwarded to the new buyer of the loan. Sometimes what happens too is borrowers will send payments to the previous servicer, even though the hello and goodbye letters went out. And then generally what that servicer will do is they will forward it to the new servicer if it's after the cutoff date. But they don't always do that, right? So you want to go back and look at the pay history and look at the loan and see if anything's missing, because sometimes I've had payments that went to a previous servicer that they didn't transfer, and then I have to kind of fight with them to get it back. So you do want to go back and do kind of a double check once the loan gets boarded. Now, if you're buying a performing loan that's continuing to perform, you're going to be good for a while, right? At this point, you kind of sit back and collect payments. This is where now you get your cash flow, right? That's what the whole thing is about. But if you bought a non-performing loan, then now it's time to start what's called the loss mitigation. So this is outreach to the borrower to try to work out some sort of resolution. And generally, this is handled by the loan servicer. There are some third parties that can be hired. There was one that I used to use that I liked a lot that's no longer in business. Some people do it themselves. If they understand all of the rules, they've had the proper training, and they really, really know what they're doing. If you're brand new, I recommend staying the heck away from this and working with your loan servicer to have them contact the borrower. All right, so now we've done our non-performing note. We've kicked off our loss mitigation. What are some of the exit strategies that we can use, or what are some of the ways that these things can get resolved? I'm going to talk about 5 of the main ones. If you broke this down, there's probably an infinite number you can pursue, but I'm going to talk about just some of kind of the most common ones. So the first one is just reinstatement, or what I call like the magical reinstatement. So I bought more than a few loans where the borrower just got caught up on their own. This typically happens if they're not that far behind. It's not really a strategy so much as something that just kind of happens. But what I found a lot of times is when I'm buying loans, especially from some larger institutions where they might have portfolios of thousands of loans, they have some get delinquent and they're just too big to keep track of everyone. So sometimes when you do that initial borrower outreach and loss mitigation, they see someone's paying attention and they reinstate. This is like a home run outcome. This is the best case. And it actually happens a little more than you think, but it's not something that you want to count on going in a deal, right? Because it's not something that you can force to happen. Sometimes it happens, sometimes it doesn't. Exit number 2 is a modification. So, and this is more of my go-to strategy for non-performing notes. This is where there's some borrower outreach done to see what's going on, determine if they want to stay in the home or not. If they do, usually put in some kind of forbearance agreement with trial payment plan. And I had a previous podcast where I did a deep dive on how those work. I think it was 42 or 43, but you can go back and check that out if you want more of the details on how those work. But this is where we're working with the borrower to come up with some agreement where they're going to get back on track, demonstrate that they can pay reliably, and then we're going to do some modification to the loan so it's now a current loan instead of a delinquent one. Number 3 is what's called a deed in lieu, or often known as cash for keys. So a deed in lieu basically means that the borrower is going to sign over the deed in lieu of going through a foreclosure. And often when you do these deals as an incentive to the borrower and also to often help pay for some of their moving costs, you'll offer a cash incentive to do this as well. So you might approach a borrower and say, well, we do this deed in lieu. If you sign it over, I'll give you $2,000, just throwing out numbers, to do it. And that'll help maybe pay for their first month's rent in their new place and cover some of their moving costs. You might ask, like, why would you pay someone cash who's already not paying the loan? That seems kind of disgusting, and it sort of is in one way. But from your perspective as the lender, right, depending on the state you're in, your foreclosure process may take 12 months. It may cost you $5,000. So spending, let's say, $2,000 or whatever can be a lot cheaper and a heck of a lot faster than going through that other process. So as you're doing these deals, right, you're always looking at what your alternatives are and what the outcomes are to you, not necessarily like what you consider fair, right? Because more than likely, I'm willing to bet that almost all the people watching this video, right, like they pay their mortgage on time every month, and they're not going to expect someone to like pay them to leave. But these deals happen all the time. One thing to watch out for on these, though, is a lot of times if a borrower is being difficult and all of a sudden they're willing to do this, it sometimes indicates there's something wrong with the property. It could be a cracked foundation, a bad roof, bad furnace, whatever. So you want to look out for that as well. Exit number 4 is just foreclosure. This is kind of something that I actually try to avoid, because one of the great things about loans is when they're paying, sitting back and collecting cash flow. So usually I go out of my way to try to get to exit number 2, where we get to some kind of modification. But if push comes to shove, then I have to foreclose, right, to protect my interest and get a return to my investors. I've had some home run results with foreclosures, and boy, I've had some horror shows with REOs that have taken back as well. So, if you can get to a modification and a reinstatement, then you're going to end up with a very high return overall. That's pretty predictable. When you foreclose, it's a crapshoot. I've had some that have had really epic returns where the borrower was just kind of an idiot and walked away from equity. And I've had others that I've got upside down on. I've had hoarder houses with waist deep trash throughout. It's really a crapshoot once you get to foreclosure. And number 5 is a strategy that I don't personally use, but a lot of people do, and that's to sell the note. So what some people do is they buy a non-performing note. They'll do their loss mitigation and outreach to the borrower to try to get some agreement in place to get it reperforming. And if that doesn't work, they just turn around and sell the note and try again with another one. If you do that, you're probably going to end up taking a small loss on the deal because you're going to have some expenses. Maybe the loan is now more delinquent than when you bought it. So you're going to take a small loss when you do it. The advantage of doing this is you're not going to end up with a hoarder house REO like I have. I don't do this strategy because what I like to do is take everything to the mat, basically. So if I can't work out anything with the borrower, then I'll drive it all the way to foreclosure. And the reason I like to do that is, number one, it enforces some discipline on myself when I'm in the buying process, right? So I don't want to buy anything that I'm not willing to own. It's a good forcing function to keep me away from stretching into some sketchy deals here and there. The other thing that happens a lot is some borrowers, I've had several borrowers who I could not get to make a $300 or $400 monthly payment to save their life. When you got to the end of foreclosure, all of a sudden they cough up $5,000, $6,000, have even had $7,000 to fully reinstate the loan. There are some borrowers who, want to keep the property no matter what, but they also don't like paying. But if push comes to shove, they'll do whatever they need to do to cough up a reinstatement. And so if you sell the note before taking it to that length, then you also miss out on some of those reinstatements. So as you're probably beginning to gather, even though this is the Newbies podcast, there's a lot of flexibility in notes and a lot of different ways to exit, ways to recover if things don't go the way you thought. One of the things I really love about this, I probably should have put this in the section about reasons to buy notes, is you got a lot of flexibility and a lot of options. So if game plan number one doesn't work, you've usually got fallback plans you can rely on as well. Now, when you do, let's say you foreclose or you do a deed in lieu and you end up with an REO, there's a lot of different ways you can deal with the REO at the end. The one that I like to do is just sell the REO as is for cash, usually to some kind of a cash buyer. For me, all of my notes are at a state, and I really try to avoid rehabs. I do rehabs now and then if it makes sense, but for me, that's just kind of asking for trouble. I like owning paper and collecting payments. I really don't like dealing with REOs. So if I've driven one into foreclosure and I couldn't work out anything with the borrower, I'm going to get what I can for the property. And like I said, sometimes that works out great. Sometimes it works out not as good. Lately, as we get to the end of 2020 here with the, kind of shortage of properties on the market, I've been doing pretty well with my REO sales because there's not a lot of them out there. So when I have one, they go pretty quick. But that's my strategy. What a lot of people do, though, is they like to do rehabs and sell, right? Especially if they live in a state where they can buy notes. And that's what they like to do. If they're using the purchase of the non-performing note as a low price acquisition strategy, then that can be a good way to get rehabs. So some people will do foreclosures to get a property that they can rehab and then resell for something closer to the ARV. Or some people like to turn them into rentals. Some people like to turn them into rentals and then sell them as a turnkey rental, because if you do that, now your market for selling that property is not just the local area, it's actually kind of nationwide. And then what a lot of people like to do are create new notes, right? So you can put a new borrower in there and do seller finance. I've done this one a little bit myself. It's a strategy that I like as well. So lots of different ways to deal with REOs depending on what your intention was going into it. And the big question, I probably should have led with this, but what kind of returns can you expect doing this? And I'll start by saying that I've got a pretty good sample size for the deals that I've done. I think I've into 80 or so far. And I'll give you kind of some of my key takeaways on what you can expect. And I'll tell you, number one, that there's a lot of variation in returns from deal to deal, and then I'll give you some of the averages. So when you're doing notes, I used to be big into games, and kind of the analogy I use is no investing is poker, it's not chess. So in chess, the best player tends to win. There's not a lot of variability. If you take a certain strategy, you can kind of expect a certain outcome sometimes. Whereas poker, the best player is going to win over time, but there's a lot of randomness in the middle, and that's kind of how note investing is. So really, it's best if you can do these with the intention of doing several and getting a decent sample, because you're going to have some that are amazingly good. You're going to have others that get sideways on you. But in general, if you're buying performing notes, I'm usually targeting an annualized return of 8 to 15%. And actually, most of the ones I'm buying are in like the 12 to 15% range. Now, of course, there's no free lunch with that. As you get into higher yields, there's usually higher risk involved with that as well. And if you check out, I've got a pricing course that's very cheap, where I go into pricing performing notes and I talk about some of that, assessing the risk. One of the big mistakes people make sometimes is they want to try to eliminate all risk. And then you can do that, but you're going to have a note that has a much lower yield, right? So if you're too risk averse in these, then you end up not getting any deals. The other mistake people make is they go, well, I'm a really good note investor, so I only want to buy things with like a 20% return. And then what happens is you have sky high risk, and so the only bids you get accepted on really, really junky loans. So mileage varies depending on the quality of the loan, but I think you can get 8 to 15% annualized returns with very reasonable, very favorable risk-reward profiles. Now, if you go into non-performing notes, this is where it's a crapshoot, especially when they turn in to REOs, because I've had a wide when you do non-performing and you end up with REOs, then your exit's all based on the value of the property. But you don't know the true value of the property because you can't inspect the inside. So if the note becomes an REO, I've had anywhere from minus 20% returns to plus 120% returns. It's really a big crapshoot. However, if I follow my model for non-performing notes, I get about 2/3 of them to reperform. And if I'm getting a note to reperform, then my returns are going to be about 30% plus annualized, and sometimes higher, depending on how well I was able to buy it. So what you're looking at is for me, about 2/3 of the time getting 30% plus, and then that other third of the time getting a crapshoot with some home runs and sometimes getting upside down on them. So another thing I really want to point out too is that, like I said, like this is poker. This is like a numbers game, and there's a wide distribution of outcomes. So if you do enough notes, you are going to end up with some REOs where you get upside down. It's a fact of life. One of my other pet peeves about the industry is I've heard people say things like, "Oh, if you do everything right, I never lose money on a loan." If someone tells you that they've never lost money on a note, then either they're a liar or they haven't really traded many notes and they're not very experienced. They could even be both. Who the heck knows? But it's a numbers game, and I'll tell you what, the numbers over time are super, super favorable, and I have the data to back that. And also, again, I'll just caution you not to what they call getting drunk on yield, right? So be a little careful about just trying to chase the notes with the highest yield because they often carry additional risks with them. So make sure you understand the risk profile of the loans and what your goals are, and make sure everything's in line. So for example, I mentioned I like to buy performing notes for my self-directed IRA. I actually target lower yields in the self-directed IRA, right? Because I'm a little more risk averse in that I just want that to grow steadily. So those are some good things to think about. And I'm going to wrap this up with a couple of quick case studies. If you go to the Fusion Notes website, there's a whole subpage with case studies where I've got, I think, 20 of these or so. But I'll show a couple just to kind of give you a flavor of some of the things you might see. So this first one I'm going to talk about was in Evansville, Indiana. I like Evansville a lot. I've been through there. It's, not the biggest town in the world, but it's decent size and pretty nice. I've done some road trips through the Midwest to, check out some of these cities, and it's always interesting. I mean, some of the cities I've gone to, I expected to be nice and were dumps. Others, are really, really nice and have a lot going on. Evansville is one of the ones I like. So this was a loan that's what I call kind of semi-performing. They were, 3 months behind when I bought it, so technically non-performing, but there had been a lot of cash flow. They weren't that far behind. And this is one where the borrower had hit a hiccup. I think it was a temporary job loss, or it might have been a medical bill. Medical bills, job losses, divorces are pretty common reasons for a borrower to get behind on a loan where they then get caught up later. And this is one that basically just reinstated on its own. They were able to get caught up on their own, which was really nice. And so I ended up with a annualized return of 14.9% on this one. That worked out really well. Here's another one that was in Anderson, Indiana. Anderson I actually don't like as much. I've done a few notes there. It's an okay area. I'll do stuff there again. You got to be a little bit careful there depending on where you are. But this is one that was 7 months behind. And then after I bought the loan, found out that the previous lender actually had set up a forbearance agreement with the borrower right before I bought it. So it's kind of funny. Some of these funds you can buy from, they're not always the most organized, right? So they sold this right after they did all the work, but they sold it to me at the non-performing price. And then fortunately, the borrower was able to come through on that agreement. And this worked out really well. This is one that I did a joint venture on where I was splitting the returns 50-50 with a funding partner. And the funding partner had a ROI of 17.9%, an annualized return of 19.3%. But that was after the 50-50 split, right? So if I was doing this just purely with my own money, the results would have been double, so I would have been in the high 30s of ROI. And this is one of those, 2/3 reperforming that can work out really, really well. This last one that became an REO. So this was a contract for deed, which I'll talk about in another video. But you go through what's called a forfeiture process. It's very similar to a foreclosure, slightly different. Tried to work with the borrower to get this thing repaying. We had various agreements in place that she never followed through on. Ended up completing the legal process. And this is a really strange borrower. She left the property in pretty decent shape and basically walked away from a lot of equity. And this turned out being an ROI of 68%, and the deal went fairly fast, and the annualized return was actually 83% to the funding partner. That was after the split. So this was an epic home run. I mentioned in REOs, there's a lot of variation on returns. I don't present this to suggest that this is normal. I've had basically 2 REOs that have had similar results to this. I just had a similar one. In Omaha, I've had other ones that I've gotten like 20% down. I've had a couple of those, actually. But I just show these to give kind of a flavor of some of the things that are possible. If you go to the Fusion Notes website, I've got a bunch more of these you can peruse. So that's my note investing for newbies. Let me know what questions you have. Please subscribe to the YouTube channel or the podcast if you haven't done so already. And if you're relatively new to notes, there's other content you want to see or things you're struggling with or can't find information on, let me know. And I'll see if I can do an episode on that or maybe just another YouTube video as well, because I want to try to put out more content for folks that are new to the space. So until next time, thanks for watching and listening.